This is Eric L. Donovan, the Mindset Disruption Strategist. Let's talk about tax planning. More specifically, let's talk about why estate taxes are optional. But before we do that, make sure that you subscribe to this channel, hit the notification bell so that you can continually get updates on ways to make a greater kingdom impact and build generational prosperity for your family and for generations to come. I also would appreciate it if you'd like this video and leave any comments. I love just hearing what you're learning and what you're seeing as we have these discussions to disrupt your mindset around how the rest of the world has you thinking about tax planning and other generational prosperity concepts. So let's get into this specifically and let's talk about why estate taxes are optional. Now, I'm going to make a comment that frustrates a lot of people sometimes, but what I like to say is estate taxes is a tax paid by people who are lazy or indifferent about their wealth and their impact and their generational prosperity. Because estate taxes are optional, especially to the diligent, especially to those who are paying attention. And I'm going to show you 3 specific examples today of why that is truth. But like, well, Eric, why does everyone talk about estate taxes? Well, because as the word that I like to use is there's an unconscious manipulation going on inside of the industry. It takes more time to help you figure these things out. It takes more strategy. It takes more intentional conversations to help you look into these things. And the entropy that happens inside of the industry is estate taxes, you're just going to have to pay them. And that's a lie. So let's go through some specific examples. But before I do, if you've watched some of my other videos on estate taxes and things like that, let's set some things up just so you know, because I'm going to put some numbers up that are going to look rather large. And you're going to be like, well, Eric, maybe this doesn't apply to me. And I'm going to encourage you just to watch so that you conceptually understand that there are options. Because estate tax laws are changing all the time, and you've got to stay on top of them and know what's happening. So as it exists today, each living person has $12 million that a little over, that they can pass either through estate or gift taxes. And today we're talking about estate taxes. If you want to talk about gift, I've got another video that goes more specifically into that. But each person has 12 million, which means each couple has 24 million. And so not necessarily everyone is going to need $24 million of exemption or ideas to avoid this type of tax, right? So we're talking about a very specific person who falls into this. However, the numbers do change, especially depending on where you are inside of that and the growth you might experience over the next few years. Because on January 1st of 2026, everything that currently exists gets cut in half. The current law sunsets back to $6 million a piece. So, and that gets adjusted for inflation every year. We're not going to get too much in the weeds on that, but that is true of what is happening. In my lifetime, the estate tax number has been as low as $1 million a piece. It's been 3 million. It's been 5 million. It's been the 6, right? So it moves all over the place. So just because I'm throwing up $50 million doesn't mean that during your lifetime, you might not need to be thinking about this and say, hey, I know Eric showed me that estate taxes are optional. What can I do to be more strategic? So as I get into this example, keep that in mind. And I look forward to showing this to you because this, to me, what we're about to walk through is a ton of fun. And you may think I'm a little nuts because I said that, but let's talk about the base case scenario of what we're dealing with. And so we're talking about Bob and Mary Smith, who have a net worth of $50 million that they're going to leave, pay estate taxes on, and just kind of go through their lifetime. So Bob and Mary, when Bob passes away, a lot of times inside of estate plans, you will find that there is a trust set up for the family to hold on to Bob's lifetime exemption. Again, in this time that we're talking about a total of $12 million. And for those of you who understand how a lot of this works, my advice to you is I know there are other laws, there's lifetime exemptions, or there's yearly exemptions and things like that. We're not getting into the weeds. We're trying to keep this high level and just help people learn and understand what's happening. So I know all the other options that are out there. We're keeping this simple for the sake of instruction and education. So during Mary's lifetime, she has the access to the income and principal off of this 12 million should she need it, right? Say the 37.9 isn't enough. She has access to the trust, but it's protecting that exemption on behalf of the family. And then when Mary passes away, that 37.9 million pays $8.3 million in estate taxes. And then to the family goes this 12 million from the trust, and then the remainder from Mary's portion of 24 million. So a total of 36.6 million going to the family, and then this family set up a testamentary, or after they were dead, gift to a giving fund of $5 million. So this is a pretty standard estate plan that we might see when we partnered with other families or worked with people kind of going, this is pretty standard of things that would get set up. And a lot of people have something like this where they're paying the estate taxes. But again, the estate taxes are optional. Now, there are a ton of moving parts that can happen. For the most part, in the three examples that I'm going to give you, the thing that we worked with was what are different ways to get a total of 36.6 million or a little bit more to the family. So the family ends up exactly where they are today without paying any estate tax. So when I go into these examples, keep in mind that was the goal. Could we get more to the family? Sure. And we're going to show you one example where that happens. But just because we came up with the outcomes doesn't mean we're limited by the outcomes. I just want you to see the possibilities. So let's dig into example number one. Bob and Mary, during their lifetime, create a wealth replacement trust, also known as an ILIT. It's a life insurance trust. So they're making annual gifts of $75,000 to pay for a life insurance policy valued at $12.5 million. Then when Bob passes a second to die life insurance policy, it's based on whether Bob or Mary pass away, who passes away last. And in this example, we're going to assume that Bob passes first. So Bob passes away. There's $37.9 million going into personal assets. There is $12 million, again, going into Bob's lifetime exclusion, and Mary has the principal and income from that trust, just like before. The only difference is we bought the life insurance policy. When Mary passes away, this $12.5 million life insurance policy passes directly to the family. Then the heirs get $12 million and 60, so we're at $24,588,000. Mary leaves her $12 million to the family. Now we're at $36.6 million, right? That's what we said. We just show you how to get there exactly the same. The Smith Giving Fund gets what's left over, $25.8 million, and the IRS gets nothing. I go, Eric, what if I want to get more to the kids? Well, maybe you buy a bigger insurance policy. See, there's all sorts of ways to move this around. As we said, the example was, let's get 36.6 million, just like we got previously, to the kids. And here's the question we always ask families. Would you rather direct this money, like 25.8 million going to the IRS? Your kids and family still got the exact same amount of money. Would you rather give it to the IRS, or would you rather give it to the charities and nonprofits and those doing good work that are important to you? That's the question. Wouldn't you rather have 25.8 million for your family to do good works after you're gone, knowing they've got the 36.6 million still available to them? Again, zero estate taxes. Pretty cool. That's just one example. I told you I had three. Let's go look at example number two. So in this example, out of the $50 million, we take an asset worth about $12.5 million and put it into what we call an accelerated inheritance trust. It's a charitable lead annuity trust is the technical name for what this is. I don't get too caught up in that because it doesn't really matter the specifics. I'm going to show you how it works. But typically a family who has, when would someone use this? Well, a family who has a piece of real estate that they want to get to their kids, the real estate is paying income and they don't need the income from the asset. That would be a typical type of asset that would go into a trust like this. So in this example, the other thing that happened by putting it into this trust, because of the way this trust is structured, what the IRS says is there's lack of control and lack of marketability because you put the trust wrapper around it, and we got a 30% discount on what went in. So we got $12 million in, but as far as the IRS is concerned, it's closer to 8 because of the 30% discount, which is going to make a difference because when there's a calculation that says over an 11-year period, we're going to have to pay the income, and it's about 7% income, $876,000 going into the Smith Family Foundation. So that income goes. How's the 11 year? Where do you come up with 11 years, Eric? It has to do with this discount and the return. Those two things together and interest rates will bring you to a point of a calculation that tells you how many years. So you're going to need a tax professional to help you figure this out. But for an 11-year time period, this is going into the Smith Family Foundation. Now, there's not a tax deduction for this because it's going directly to the foundation and your family's about to get benefit from it. So in this particular instance, this is not counting towards your annual charitable giving from a tax deduction standpoint, but you're going to watch this. This is going to do some pretty cool things from an inheritance standpoint because, well, Eric, what happens after year 11? After year 11, the value of that asset goes to the family free of gift taxes or estate taxes. You gave up the income for 11 years for the purpose of giving that income to an entity that you care about and you want to see a difference. And then at the end of that 11 years, the asset drops down to the family. So now we've turned this into a lifetime inheritance and we haven't paid any taxes on doing it. What else happens? Well, now Bob passes away. Mary gets $25.4 million. Bob's family trust gets $12 million. Again, she has access to income and principal. When Mary passes away, $13.1 million goes into the Smith Family Foundation. You get $12 million passed to the family heirs, and then you get another $12 million passed to the family, again for a total of $36.6. But remember, $12,528,000 went to the family during their lifetime. How much more could they compound that? How much more could they use that? It all is beautiful because no estate taxes, no gift taxes, and the family wins, the kingdom wins, the impact wins, generational wins. I mean, this is incredible stuff just because of strategic planning and thinking through. I know estate taxes are optional. What do I want to create? Let me show you this last example. And we're going to bring in another tool and kind of just show you there are all sorts of creative ways to do this. There is no one way to do this that matches every single person. What we found is that based on what you're trying to do, there are all sorts of tools that might work really well. And that's why I showed these to you. So Bob and Mary Smith take $8.3 million of assets and put it into an enhanced income trust for the income benefit of their kids. So typically what you would put into this trust is something that you have a very, very low cost basis on, that you're not getting a lot of income from, but you want to turn into income. So many times this is a tool that people will use before they sell a business because the business isn't producing as much income. And again, this isn't everything that they own, or a piece of raw land that hasn't been producing much income, but you're about to sell. Why? Because we're not getting into the nuances of this, but this enhanced income trust, when it sells the asset, doesn't pay any capital gains taxes. So it's a beautiful tool. It's called a charitable remainder trust is the technical name for it. But this is a cool little tool because when you put the asset in, not only when you sell the asset do you not pay any capital gains taxes, you're going to get a tax savings, tax dollars into your pocket of 1.16 simply for making this move. Now, this particular trust in this instance is being set up to give a lifetime income to Bob and Mary's kids. So we're looking at about $418,000 of annual income and a total of $14.6 million based on some estimated lifetime. We said 35 years was how we kind of estimated the lifetime income. How powerful would that be if just through some of your strategic planning and minimizing capital gains taxes and some other things, you could get annual income to your family during their lifetime? We've had families who've used this type of strategy to get income to daughter so that they could stay home and not work, right? It's all sorts of beautiful ways you could use this, but this is just one. And again, no gift taxes, no estate taxes, and no capital gains taxes paid on the assets sold here. You remember the last example where we took the accelerated inheritance trust and used something like a building that was paying income. So they take another 17.5 million, put it in here. The exact same thing is happening. So we get 11 years of 1.1 million paying out, and then we pay to the family after 11 years, putting this asset in. Now the family has got not only income, another 17.5 million of an actual asset during their lifetime, $32 million going to the family, lifetime inheritance. Have we paid any taxes? We have not. We paid income tax, but we've not paid any estate or gift taxes, and we avoided some capital gains taxes right here, right? So what happens here? Well, now Mary has 14.5 million that passes to her personally. Bob's family trust has 9.5 million, and we're going to watch something happen here as we kind of trickle this down. She still gets access to the income and principal. Because remember, we started out with the example of $5 million going to charity. What we assumed in this example is that they at least wanted to get $5 million to charity. So you're going to watch some things happen. So there's only $9.5 million going to the family trust here, and another $9.5 million going to heirs here. And it had to do with the lifetime exclusion amounts that were left from making this gift here. So they had to use some of their lifetime exclusion here. So some of that was done, and then also assuming this $5 million. So there's a couple of things going on behind the scenes there. But look at this number with me real quick, because we don't need to get into the weeds on this. I just want you to see the possibilities. This is a total of $51.2 million. We originally said we were trying to get $36 million to the kids, but there's $14.6 million of income over this 35 years coming to the family that effectively makes this inheritance 51.2. And oh, don't forget, they got the 17.5 during lifetime as well. Now, one thing that does happen on this that you need to recognize, this $8.3 million that's up here in this enhanced income trust, when these kids pass away, so no estate taxes. When these kids pass away, it goes into the family foundation. That's the agreement. It pays a lifetime of income to these kids. And then when they all pass away, it goes into the family foundation for your grandkids to give away. But your family here should be doing strategic planning to allow them to continue the legacy, to continue the generational prosperity through conversations and activation that you've already been talking about. I know I just threw a lot at you. All I want you to come away with is really one idea. Estate taxes are optional. You do not need to get into the weeds of the specifics here. What I need you to understand is they're optional, and they're paid by people who are lazy and don't think ahead to do strategic planning, or don't take advantage of the purpose of understanding the impact they want to create and the true generational prosperity that they want to build, so that they can be intentional about their outcomes. Because so much of the industry is built upon this unconscious manipulation of it's just going to happen and you're just going to have to do it. And I'm like, why? Why would you do that? If you are purpose driven and you want to impact your family for generations to come, wouldn't you be more intentional? And wouldn't you want to take control? Because when things are optional, it means you have opportunities. And why wouldn't you take advantage of those? Thank you so much for being here. Again, I look forward to your likes and comments on this video. God bless you. Have a fantastic day.